is mortgage insurance? Do I need to pay this when I'm buying a home? What does it do for me? My name is Christina Jamison. What is mortgage insurance is a common question. So people that have a loan that's more than 80% of the value of the property will be required to pay mortgage insurance. It's an insurance that basically covers the bank. It does nothing for you, and it's an insurance that basically, if for some reason you forfeit on your repayments and they have to sell the property, that's covering their costs of getting a real estate agent to purchase it, kicking you out, all the legal costs and getting you out of the property so they can actually return the money to them. So that's a mortgage insurance, and that's what you have to pay. It is usually, it could be anything from $1,000 to $30,000, $50,000, depending on how much you're borrowing and what percentage of the property you are borrowing for. In most instances, I would recommend to avoid mortgage insurance. Why? Because even when mortgage insurance is involved, they are more stringent in their categories, in their expectations of the borrower. Now, I remember that when I did one of my loans as a mortgage insurance, I got asked so many questions like, what's that payment coming out of your account? Why did you do this? Where's that? And it's like, I was actually quite competent in actually managing my money. So I was very surprised that they were so stringent in getting their approval and trying to actually micromanage everything that I did for their security. So they are tougher. They are more difficult to work with. In instances, I would usually recommend that people try get an 80% loan. Now, in this market, I perfectly understand that it is not that easy to save up 20% deposit. But if you do, that's great. Or even using first home buyer guarantees. Now, first home buyer guarantees, what that does for you is that, for example, 20% deposit is secured not by cash, but by someone's home. So if you combine the two securities together, now when I say security, I'm saying the property that you're buying and your family home, then the ratio or between the two properties, your borrowing amount, so it might be 90% of the property that you're purchasing, but when you combine the two properties, you're looking at, say, 40%, what we call LVR, loan to value ratio. So therefore, you don't have to pay LMI because they've got the other house to secure. So what they're saying is, we don't expect that you're going to cost us that much. If in any case, the worst case scenario is you miss repayments, your parents aren't there to help you, what have you, then they are able to withdraw some funds and actually cover their insurance costs. So even for the family, there is limited guarantee. They can't just sell your house. They have 20% maximum as a guarantee of that property. So LMI, I tend to say, try to avoid it as much as you can. Home deposit loans is a new concept that's coming out that can help you. Specifically, it provides a second mortgage on your property that you're purchasing and actually allows you to avoid paying mortgage insurance, which, you know, that is $30,000 extra. And the interest that you could pay to be able to get a deposit, a home deposit loan, more than covers and is much less than the $30,000, for example, that you're going to be paying just in pure mortgage insurance. So very often I say do not get a loan, but in instances where mortgage insurance is involved, then sometimes it's worth considering getting a home deposit loan to avoid costly mortgage insurance, which in effect has no benefit to yourself. Well, if you want any more information about things such as home deposit or even discussing mortgage insurance, feel free to contact me at School of Home Ownership.